73% of the world's equity market cap is now in the US. And indexing is the way people go these days. So if everyone, everywhere out in the world invests in the world index, 73% of his money goes into the US. And out of those 73%, probably more than 1/3, close to half, goes into 10 stocks. And that is a fantastic concentration we have never seen before. And that's great as long as it goes up. When it reverses, it will be ugly, because then you have the concentration working against you. I don't know when we hit that point, but when we do hit it, it will not be pleasant, that's for sure. So I'm concerned that sometimes in 25, liquidity that has been plentiful over the last 2 years will begin to dry up, and that's when market bubbles break. And I'm concerned about that. I do not know exactly how this will work out, but I'm prepared for it, and I'm waiting for it. And I think it all feels like it's late stage. The valuation is historical. It is close to the historic highs, or depending on what yardstick you take, it could be even the highest. It's a heavy concentration. It is a credit boom that is going on. A lot of the boom is taking place in markets that are hidden, that are private markets, not public markets. And you see some of the anecdotal evidence popping up that you usually see late in the bull cycle, like the famous bear turning bullish, something like that. And I'm waiting for more of those news to get a grip on it, because you cannot call the turn based on fundamentals alone. We know the fundamentals are there. That is later stage of the cycle, but that later stage of the cycle can continue to be postponed and postponed and postponed. So I think we just collect more anecdotal data and evidence of the late stage and are waiting for the technicals to show us what's going on. In recent weeks, the breadth statistics have been deteriorating. It's probably too early to call this a major top, but it's beginning. During 2024, you saw that one market after the other was beginning to lag and falling behind, and that's another indication of a late cycle phenomenon when the focus of the money is on lesser and lesser, fewer and fewer instruments. And so we are in the late cycle, but I cannot tell you far ahead when it will turn. It's even worse when you look at the fundamentals. I just looked at some of the data and saw that in the third quarter, the Magnificent Seven were up in earnings 18% or so, and the 493% were up 0.1%. You know, that's such a difference. That's dramatic. Or companies from 2,000 to 3,000 smallest in the Russell 3000, 2,000 to 3,000, 1,000 companies, more than 50% of them are loss-making. So it's not such a widespread prosperity, and therefore the concentration is somewhat fundamentally based. But what starts out for a good thing, eventually when it goes to an extreme, becomes a bad thing. And I think we are on the way to that. And I think 25 will bring us a reversal, because the liquidity that was pushed into the market came out of the reverse repurchase agreements. Those were about $2 trillion. And we are down in the very low numbers, 300 billion or something like that. There could be a little bit coming from the general account of the Treasury, But other than that, you really needed QE or the Fed going bonanza. And with growth being at 3.3%, according to the Atlanta Fed in the fourth quarter, based on released indicators so far, it's very tough to see that. So therefore, what we are in is we are in a situation where liquidity continues to grow, but I think it begins to grow at a lesser and lesser rate. And that's when the bubbles become dangerous. So I think at some point in 25, it will burst. On the positive side first, we have the unique situation for the first time in modern history and for the only country that I'm aware of that labor supply has fallen below labor demand. That's unique. That has never happened before. And this keeps employment situation and the income situation relatively steady and stable. And that has probably aborted many of the recession pointing indicators as not being valid. That's why so many indicators have been wrong. So we have, of course, the employment situation is softening. I see that also, but we are not at the point where supply falls below demand. And once we hit that point, sometimes in 25, then the economy could, of course, weaken, and weaken more than many expect, because then all of the restrictive policies of the past could really show up. The other thing is, as you already mentioned, Doge, they will not cut out the 2 trillion, as Musk said at the beginning. He's down to 500 billion. 500 billion represents approximately close to 2% of GDP. 2% of GDP that would be lacking, would go away, evaporate, because one guy's expenditures are another guy's income. And so it's gone. And what would be good longer term for structural reasons would be quite bad in the short term, because it hurts. You lose growth. The other thing that I'm concerned about is trade. Trade will not be so easy to solve as many think. Many believe that the trading situation with tariffs, Trump uses this as a stick for negotiation reasons, but he will not stick to it. I'm not so sure. The situation is pretty ugly, because when you look at a trade, this is usually manufactured goods. And when you look at employment in percentage in manufacturing, in percentage of total employment, this is relatively low around the world. So trade will not make such a difference. I think if Trump believes that he can move a few percentage points of the manufacturing capacity from China to the US, he may be wrong. That may not work that way. 1/3 of global manufacturing capacity is now in China, and the world depends on China. And if we make products more expensive, tariff is a tax, then somebody has to pay for it, either the consumer with higher prices or the producer with lower prices. So there is a tax. And taxing and tariffs do not lead to prosperity. Historically, they have led to a different outcome, just the opposite. And the tariffs that Trump is talking about, 10% for everyone and 60% for the Chinese, when you look at that, then you are in the period, those are tariffs that were applied in the period from 1900 to 1945, after World War II. If he does only half of what he said, then you are in the period from the beginning of World War I to the end of World War II. When you look at those periods, they have not been very pleasant. Aside from the wars, they were very difficult, nasty economic situations. Of course, we don't have the gold standard these days. We have fiat currency situation. So I'm not suggesting we go into the 1930s, But I'm suggesting that those are the two risks, the Doge cuts and the trade that cuts out maybe 1% or so of the US. And then the other guys will not sit tight and do nothing. They will retaliate. So those tariffs go up as well. And then you are in the midst of a trade war, and a trade war could escalate as a political confrontation, could escalate in a military confrontation. So we do not know where we will end up with. I think we will sail through some rough water in 25, and I do not believe that we will have a straight up market as we had in 23 and 24. But I think we will most likely see wild swings in the market that could be part of a cyclical top building process. And the way I look at the technical situation, it looks like we could build a medium-term top early in the year, in the first quarter, and then have a decline. I do not know how deep it will be. And then another run-up, usually with more divergences, technically speaking, to higher highs, and that should be it. So this is how I figure 25 could evolve.